So you know those invisible digital robots that companies use? What happens when the company making them actually starts generating real, hard cash? Well, welcome to the EDGAR brief. Today we are cracking open the Q1 fiscal 2027 filings for UiPath, filed for the period ending April 30, 2026. We are going to translate their very first profitable quarter into plain English. But real quick, a standard disclaimer. We are independent, not affiliated with the SEC, and we are definitely not financial advisors. We do use AI to help summarize things, so errors can happen. Always verify everything on sec.gov before making any money decisions.
Okay, let's dive right into this. Today, we'll be breaking things down into the business model, the scorecard, a moat check, reading between the lines, real risks, and the bottom line. All right, part one, the business model. Let's figure out how the money actually moves. Now, if you look at the filing, you are immediately hit with this dense corporate speak, right? Stuff like business orchestration platform. But honestly, what does that actually mean for the rest of us? Think of UiPath as a massive digital temp agency. They deploy these AI robot workers to do all that mind-numbing spreadsheet work that, let's face it, humans absolutely hate doing. So they make their money by charging huge enterprises a recurring subscription fee. In exchange, the company gets to lease this invisible, super efficient workforce that just sits there, copying, pasting, clicking, and processing data all day long. Moving right along to section 2, the scorecard. Let's track the actual cash here. First question we always ask, are more dollars actually walking in the door? Yep, for sure. Total revenue hit $418 million for the quarter. That is up a very solid 17% from this exact time last year. So we're seeing steady, healthy growth. Now check this out, because this is wild. Their standard accounting gross margin, GAAP gross margin, is a staggering 82%. To put that in plain English, for every single dollar of software they sell, 82 cents sticks around. And that's before they even have to think about paying the R&D guys, the sales teams, or, the office rent. It's the absolute beauty of a software business. Making another copy costs next to nothing. But wait, here is the absolute hero number of the whole filing, $28 million in GAAP operating income. Why is this such a big deal? Because literally, for the first time in company history, they are profitable from the actual business. No accounting gymnastics, no weird non-GAAP adjustments, just real, actual operating profit. Now, to really understand where they're headed, we gotta look at ARR, which is Annualized Renewal Run-rate. Basically, think of it like a gym membership model. It completely strips out those one-time sales and focuses purely on their recurring subscription health. It's the guaranteed money they expect to collect over the next year, assuming nobody cancels. And their ARR? It just crossed $1.901 billion, growing 12% year over year. But here's the kicker. 70% of that growth came from their existing customers. This is huge because it shows their customer base is incredibly sticky. Like, once a company rents these digital workers, they never really fire them. Actually, they usually end up hiring more. And let's say, hypothetically, all revenue just completely stopped tomorrow. Well, they've got $1.42 billion in cash equivalents, and marketable securities just sitting in the bank to keep the lights on. That is a massive margin of safety. They're definitely not going bankrupt anytime soon. All right, so they're growing and they're profitable. Let's jump to section 3, the moat check. We gotta ask, why can't some competitor just code up the same bots and steal their lunch tomorrow? Well, their biggest durable advantage is switching costs. Imagine trying to rip all the plumbing out of your house just to replace it with slightly cheaper pipes. Absolute nightmare, right? Well, UiPath's bots are so deeply hardwired into core corporate processes. We're talking loan origination, financial compliance, inventory management, that customers would literally scream if you forced them to switch. Plus, they're digging a massive ecosystem moat. If you dig into their 8K filing, you see these incredibly deep integrations with industry heavyweights. They've teamed up with Deloitte for software testing, Databricks for data automation, Microsoft for security workflows, and even Google Cloud's Gemini for document processing. They are strategically making sure UiPath becomes the unavoidable toll booth for basically any enterprise software. Okay, let's pivot to section 4, reading between the lines. Let's see what management is really excited about. If you read the management's discussion and analysis, they are relentlessly pushing this buzzword, agentic. The CEO, Daniel Dines, specifically made a point to highlight that their agentic products are moving from pilot to production. That right there signals a massive, massive technological pivot for the company. So what does that actually mean in plain English?
Basically, they're upgrading their digital workers. They're moving away from these mindless drones that just copy and paste data from cell A to cell B, and they're evolving them into smart AI agents. Agents that can actually reason, react, and run entire business functions entirely on their own. Essentially, they're giving their digital workforce a massive promotion to management.
But hey, it's not all sunshine and rainbows. Let's move into Section 5, Real Risks and Red Flags.
Okay, remember that exciting $28 million GAAP profitability we were just celebrating? Well, it was heavily aided by a huge drop in stock-based compensation. If you look closely at the filing, stock-based comp plummeted from $76.3 million last year all the way down to $53.3 million this quarter. So we really have to ask, is this newfound profitability coming from true operating leverage, or are they just paying their employees a whole lot less in stock? Because in a hyper-competitive AI talent market, you really got to wonder if they can keep top talent around without those big stock payouts.
Oh, and there's another little detail buried deep in the fine print. On April 15, 2026, literally just weeks before they announced this historic, first ever profitable quarter, the CEO adopted a 10b5-1 trading plan. Now, that is an automated, preset schedule to sell off up to nearly 3 million of his shares over the next 6 months. Look, it's perfectly legal, it's standard practice, but man, the timing is definitely something you want to keep on your radar.
Finally, Section 6, the bottom line. Time for the final verdict. So, what's our takeaway here? Ultimately, UiPath is a cash-rich digital general contractor with absolutely incredible switching costs. They have finally proven that they can actually turn a GAAP profit, which is great. But the main thing to watch going forward is how much it's going to cost them to hold on to their top talent in this crazy AI market, especially given how much their stock-based compensation just shrank. So, when their next filing drops, here are the 3 things you need to track. 1. Watch that ARR and see if that 12% growth can reaccelerate. 2. Keep a very close eye on that stock-based compensation to see if it stays low. And 3. Track whether these fancy new AI agents actually translate into new, real dollars walking in the door. Because the billion-dollar question is this: can UiPath maintain its hard-won profitability while completely reinventing its core product on the fly? We'll see. And that is your EDGAR brief on UiPath. Remember, this was a translation, not a recommendation. Go read the original on sec.gov if anything caught your eye. Thanks so much for hanging out with us at the EDGAR brief, and we will see you in the next filing.